I want to start by talking a little bit about how I'd kind of characterize the traditional world of portfolio construction. So we'll call this portfolio construction 1.0, the way that most of us were brought up and trained. And it's essentially a world of strategic asset allocation. So we may have some process by which we determine client risk tolerance, either because we have a preference for that or our regulators at least expect us to do that. We then create a diversified portfolio that has no more volatility, which was our modern portfolio theory defined parameter for risk, than the client can tolerate. Hopefully we'll get some low correlation investment options in there to further reduce the portfolio's volatility, and we'd rebalance on a regular basis in order to stick to that allocation. And that was the essential focus for how most of us were trained in creating portfolios. And to the extent that we might have been trying to add value to the client, we would add value by taking those particular asset classes they were going to invest in and trying to pick particularly effective fund managers to fill in that particular box, or pick particularly effective shares to fill in that box. Now that was all well and good until we got to GFC in particular, where if we look at where everything started early on in 2007, or let's say late in 2007, and then where we finished by early 2009, we basically had two clusters of investments. Everything that had anything to do with risk, regardless of what asset class we thought it was supposed to be diversifying, and cash and government bonds that did okay. And all of these different distinctions in this category, whether it was our Australian stocks or our US stocks or our commodities or real property funds or emerging markets or anything else that was supposed to fit in the diversification box, actually ended out remarkably closely clustered in its total return drawdown. A lot of us started to talk about that as whether it was even a failure in diversification overall, because we've struggled with this fact that we're just not making a lot of progress in investing. So if we go back now about 12 years to 2000, this is the MSCI World, so our measure of global stocks, we're pretty much back at the same price point after 10 years. Now total returns were positive because there were some dividends coming along, but most of us were not doing projections 12 years ago suggesting that global stocks were going to have an annual growth rate per annum of 0. And that all you were going to get was your dividends. In fact, what really was supposed to happen is the line was supposed to keep going upwards, and if we apply something relatively modest like a 6% appreciation per annum on top of dividends, and you don't even reinvest the dividends, just 6% per annum price appreciation means we should actually be about twice as high as we are today. And so particularly when we draw back to the earlier session, talking about this in the context of our ability to fund our clients' objectives, the real reason why we're investing this money, we've had what arguably would be a relatively catastrophic risk event. We've got a 50% shortfall. The good news is it's only because we're where we were 10 years ago, 12 years ago, but we're drastically shortfalling on the goal. And heaven forbid the client was taking withdrawals out of this portfolio and was already in retirement, things are even worse. Catastrophic shortfalls. We fared slightly better here in Australia because you didn't deal with quite the magnitude of the tech wreck that we had in the US and some of how that reverberated around the world. But you're essentially about 7 years into a flat cycle yourself now, as your markets are no higher by price level than you were in about 2005 when you first got to 4,000. Again, some positive total return. You have some dividends. Your frank dividends will gross up that return a little bit more. But I suspect if I pulled out anybody's financial and retirement projections back in 2005 to look at where they were supposed to be by now in 2012, we've got another one of those really big shortfalls occurring, the same way that we had when we looked at stocks globally. And a lot of this ultimately derives from sort of this portfolio framework that we had from strategic asset allocation, which at its base was supposed to say as long as you stay invested and stay the course, you're supposed to eventually get to your objectives. Yeah, you won't necessarily get exactly 10% per annum of total return every particular year, but you're still supposed to average out to that over a reasonably long time period. Which I suppose at the most basic level raises the question of what is a reasonably long time period, as we're certainly finding from clients, things like 7 years, 12 years and counting is a lot longer than most people were expecting as a time horizon.